I understand the market watchers, the pros, will say, it's just a number. But records matter because they get printed in general news. Mom and pop who don't watch CNBC every day might hear about it. Does it matter to you at all?
Absolutely. But U.S. economic conditions favor continued expansion, rising stock prices, and that's going to continue for another 2 to 4 quarters at least, unless one of 3 things happens. Number one, we get rising inflation, and the Fed has to change its posture from one of being normalizing rates to addressing inflation. Number 2 would be the massive debt that's been built up around the world. That has to come to terms. That built up after the ZIRP environment, zero interest rate environment. And finally, if the trade war does not get resolved, let's leave out China for now, but with all our trading partners, that could be an issue for the market.
Yeah, you hear the issues here, and obviously we've had this, Joe, wall of worry. Dom Chu laid out literally the wall of worry all day on CNBC, but yet the market has shrugged it off.
Well, you're always climbing the wall of worry, and I think what's interesting about what we've done so far in 2018 is it's not so much about equities. So think about the pressure on a portfolio. Think about a traditional 60-40 portfolio. And that's where the real contagion and concern would come if the market was going to roll over. So year to date, 60-40 portfolio is up 7.4%. 30-year average is 7.8%. So we are in line with the historical average. In 2017, we did nearly 13%. So when you look
Are you arguing against a diversified portfolio?
No, I'm arguing exactly for a diversified portfolio. And what I'm arguing for is if the market was going to recognize something that was going to be problematic, where the end of the equity run was coming, I think you'd see it in the other asset classes. And in the last week or so, we're actually seeing emerging markets come back once again. So I think you could have an equity conversation, yes, breaking out to a new high, but I think you could also have a portfolio conversation, and diversified portfolios will look good in 2018, just as they did in 2017.
I mean, I think the market is doing well because the economy is doing well. CapEx is running in the upper single digits. The consumer is super strong. I mean, look at these earnings that are coming out. Consumer is 75% of the U.S. GDP. Look at Walmart. Look at Home Depot. Look at Macy's. Look at Kohl's. Look at TJX. Across the board, these companies are saying good things. Traffic is strong, in spite of Amazon, which continues to grow rapidly as well. So I think the economy is good. That translates into strong earnings. Strong earnings are going to continue this year. Even next year, they'll be double digits, and you have a decent valuation. And by the way, the market gives you looks at stocks because the reactions to earnings, sometimes they overreact, sometimes they underreact. And those are the times when you take advantage as you buy. Today, I was buying Chevron. I was buying Goldman Sachs. Kohl's, across the board, there are names that I find. So that's why I think the market continues to go higher, because there's value there.
Steph, would you, I'm not trying to put words in your mouth, but I mean, you named Macy's as one of the stocks, and obviously it had a great start and then stuttered just last, 10 days ago, a week ago, and fell from 41 to 35. Is that one of the ones you'd look at again now after that adjustment?
Both of those stocks, Kohl's and Macy's, are up 40-some-odd% for the year. So the expectations are really, really high. I think you pick one in this space, and the one that I'm going with would be Kohl's.
The discount.
Because I think that they have a game plan of fighting Amazon and getting traffic and growing sales. But I mean, across the board, you pick you pick the one that you like. You pick the strong management teams, the good balance sheets. But I think the consumer is so strong and underappreciated, and it's such a big part of our economy. How do you get negative when that sector is doing so well?
Josh, what do you think?
Well, I like that we've replaced the interest rate fear with trade war fear. I guess that's kind of cool. It's something new to talk about, and there'll be something else next year. I just think it's worth pointing out that the narrative of the bears continues to shift from week to week. So you heard them talking a lot about large cap tech stocks pulling away from the rest of the market. And then all of a sudden, the Russell caught up and started acting really well across all industry groups. And then you heard them shift, and they went to a new argument about, you don't have confirmation from the transports. Well, look at the transports today. Look at the transports over the last 2 weeks. So every time they seize on some gray lining in the silver cloud, it's really embarrassing, and it's something that we could just get used to, and it'll continue. At a certain point, this market will reverse and go into a downtrend. but it just hasn't happened yet. So this idea that you're going to predict it in advance based on 1, 2, 3 data points that you pull out of your ear, it's just not the way investing works, and it really is not something that should be practiced in the year of our Lord 2018. Nobody should be playing that game.